Welcome back to Elevate from Burnout to Bliss. I'm your host, Reggie.
And I'm Ebony.
And today's episode is going to be for people who are tired of working hard, making good money, and still feel like they're not getting ahead.
Let's be real. Most people think that if they have a CPA, they're covered. Taxes done, boxes checked. But what if we told you tax prep is not the same thing as tax planning?
That's right. Today we're pulling back the curtain on the stuff most high-income earners and business owners never hear about, like backdoor Roth IRAs, what self-employment tax is really doing to your income, and why the way you handle your retirement accounts can cost you tens of thousands of dollars over time.
We're talking about the blind spots, the missed opportunities, and the strategies that could help keep more of what you make legally and strategically.
So if you're a professional, entrepreneur, or someone planning for retirement, this episode could literally change how you think about money.
So grab a pen, lean in, and get ready to elevate, because what you don't know about taxes and retirement might be quietly costing you your future.
That's right. Let's do it.
All right, everybody, here we are, Elevate Season 3, Episode 5, What Your Accountant Isn't Telling You About Taxes and Retirement.
All right, let's get it. Let's go.
So today we're going to talk about things like backdoor Roths. I don't think we've talked about that on the show yet.
No, we haven't.
Self-employment taxes and missed opportunities for high-income earners and business owners, which I know many of you all
That's
are.
Right.
And let's get started. So we are going to talk about things like how high-income earners unknowingly miss tax-free wealth building opportunities.
Okay, before we do that, let's define what the IRS considers a high-income earner to be.
Okay.
All right, so when you talk about the high-income earner, and you know, it's crazy because that the IRS defines this across the country, but obviously, you know, cost of living, you know,
right.
It doesn't cost the same to live in Memphis as it does in New York.
True.
Or actually even in Nashville these days. But so when you talk about high-income earner, believe it or not, I think the bar is kind of low. But if a person is married or a couple is married, you're talking about $242,000.
Okay.
If you're filing single, you're talking about anything more than $153,000 a year. So that's where you're going to start to see some income contribution phase out kind of stuff.
And that those numbers hadn't changed a whole lot, even though the cost of living has changed dramatically. Mm-hmm. So that money don't go as far as it used to. No,
well, it kind of creeps a little bit, but proportionally, like Eb said, it doesn't change, but the dollar amount changes. But when you factor in cost of living, it's pretty much staying stagnant. Mm-hmm. But so your question, I think, Eb, was why do high-income earners, why they often told you make too money for a Roth IRA? Simply put, the Roth IRA, I want to back up just for a second before I explain that and tell people why the Roth IRA is such a great account for the American people. Okay?
Yes, please do, because that is the account that everybody focuses on.
It is, as well they should. And here's the reason, because with the Roth IRA, the deal Uncle Sam is making with you is that Uncle Sam says, I'm going to tax some of your seed money, mm-hmm. right? The money you put in. Mm-hmm. So what you put in has already been taxed. Whatever you grow the account to in the future, you keep 100% of the harvest. In its mm-hmm. simplest terms, they get to tax. They tax the seed, you plant it, it grows, you keep the harvest.
So, and do the contrast with a traditional IRA.
Yeah, so the contrast with the traditional IRA and with your 401k, any of your employer plans, the contrast is Uncle Sam says, I'm not going to tax the seed money. Put the money in, make your contribution. You grow it, you take the risk, you grow it, and then when it's harvest time, meaning mm-hmm. when it's time for you to take from the account, I'll come in and tax some of the harvest, mm-hmm. right? So the Roth IRA, simply put, guys, is such a great account for the American taxpayer is that it's actually come up for repeal multiple times.
Wow.
It's just never got out of committee, which is great. So I do encourage people to take advantage of it. But all of that being said, so just understand, and again, in simplest terms, this is an account where you can put money in that's already been taxed. It's going to grow tax-free. And as long as you meet certain criteria, you can take out, of course, what you put in tax-free and all the earnings that it's made tax-free. It's a couple of hoops you got to jump through, but they're pretty simple. But so just wanted to be sure everybody got their base before we start talking about.
Right. And the issue comes in is that not everyone can get that account.
Not everyone can get the account. So you can make too much money. You can make too much money to be able to contribute directly to a Roth IRA, okay? And the too much money is what Ed was talking about earlier. People that, so if you file your taxes and you're single, and you make more than $153,000 a year, you cannot legally make a contribution directly to your Roth IRA. If you're married, filing jointly, then it's going to be $242,000. Okay, so there are ways that, and one of the loopholes, and it's a legal loophole, is called a backdoor Roth. There's a way people that are over these income thresholds can contribute, take advantage of all the things we just talked about by getting into the Roth IRA through the back door. So that's what we're talking about today.
Okay.
How do I get into that same thing, but just get in through the back door?
So I want you to go into how that actually works a little more.
Okay.
And then as well as who should use it and who shouldn't use it.
All right, so how does it work? So what actually happens is when you contribute to an IRA, you can contribute to what's called a non-deductible IRA. And just understand. The IRA is just a retirement account. You put the money in, but because your income is so high or higher than these thresholds, you just can't deduct what you put in. You can't get a tax break for what you put in it. But once you put the money in there, because there's no income limits on that, right? In the non-deductible IRA, you can put it in. There's no income limits. But once it's in there, you can immediately do a conversion to the Roth IRA. So again, that's how we get in through the back door. You make too much money to go straight to the Roth, so you put the money in a non-deductible IRA, and then you do a conversion, an immediate conversion, over to the Roth. And I stress immediate. There's a reason I keep stressing
That's
immediate.
what I was about to say. It is so important for it to be done immediately. So this isn't money that you put in a traditional or non-deductible IRA 2 years ago, and now you're going to convert it.
No.
You're doing it right then.
And the reason you're doing it right then, because any growth that happens in that non-deductible IRA becomes part of the pre-tax amount, and now it's subject to the taxes and all that stuff. So we kind of want to, we're really using the non-deductible as a pass-through. We're doing it, boom, then you're making the contribution. Making the conversion.
So is there any other factors that people need to consider or any reasons why you wouldn't want to do it this way?
Why you would not want to do the back door?
Correct.
Well, yeah, there's a few of them. And I would say this, keep in mind, what we're talking about, this whole strategy is for high income earners. If you fall below the 153 or the 242, depending on how you file, then you just want to contribute to your Roth IRA, okay? So that's the first thing. If your income hasn't exceeded that yet, I'm claiming for you that it will, but if it haven't got there yet, don't worry about all that. Two, another thing you want to consider is a very not well-known rule called the pro rata rule that greatly dictates how much of the non-deductible contribution you can convert over to the Roth IRA. And if you don't know that, I think I'm probably going to go into it, but that's something you want to be aware of. And again, main thing though, if you're under the income limit, hey, just make your contribution directly. But if in fact you are doing the conversion, the backdoor Roth way, then we probably do need to have a conversation about that pro rata rule.
So let's go ahead and get into that because I know there's some tax rules and things that can make this tricky. And we get questions all the time, y'all, and people want to do the backdoor Roth or try to do it on their own.
Right.
This is not the strategy that you want to try and do on your own because it is very particular in how it needs to get done. So
it really is.
And this pro rata rule is part of the reason why you need guidance on it.
It is. And thing with the IRS, you can do stuff and you can do it outside of the way they tell you to do it until you can't.
Right.
And you can get away with it till you don't. So But let me get this pro rata rule. I'm trying to make it as simple as I can. What this rule states is any amount of money that you convert over from your non-deductible IRA, that's money that's after tax. Whatever percentage you convert over to your Roth, you have to convert that same percentage of your pre-tax dollars over to your Roth. Now, whether you understand me or not, just understand this. This could trigger a very large single-year tax hit.
Yes.
That you may not have wanted to happen. All right, so let's say, for instance, you put in $7,000 in your non-deductible, but you have an IRA out there somewhere, and you converted 100% of your contribution. You have to convert 100% of the pre-tax over to the Roth as well. Again, possibly inadvertently triggering way more tax hit in that 1 year than you wanted to do. So there's ways we can legally maneuver that minefield as well. But just know, again, like Eb said, this is what, and I want to preface somewhere. Eb just said these are things you want to do under the guidance of a professional. The higher income you earn, you're going to find that you need specified professional guidance to walk you through these things. And and that's just how it is. That's just how it is. So I'm, don't want to put that out there.
And if you are a professional, which I'm sure you are, then there are people that come to you because of your specialized knowledge and skill sets.
Correct.
And outside of your specialized knowledge and skill sets, they're not expecting you to know other things.
Right.
So you, in turn, need to do. Sometimes people look at finances and like, well, it's money. Everybody has money, has access to money, whether it's a lot or a little. Mm-hmm. That may be the case, but not everyone is trained on how to handle money and the strategies that we're talking about today. So some things can be a little more simple. You may be able to watch a YouTube video or TikTok. Completely not advisable, but there are some things that you absolutely 100% should seek the guidance or advice of a professional.
Absolutely,
because the consequences are too high.
They are. I mean, you're playing with not playing, but you're maneuvering around, more money. Therefore, it's more liability, more risk, and you want to get these things done right.
And just to add, we kind of briefly talked about it, but mistakes that we see when people try to do backdoor Roths on their own without guidance. And one of those mistakes is waiting and not converting it immediately.
That's what I was going to say. Another mistake, well, actually it's a part of the same answer, not converting immediately, or what can really make it tricky is when you're doing monthly contributions to the non-deductible IRA. And then you convert maybe you're doing $500 a month to your non-deductible IRA. Then you say in December, I'm going to convert it to the Roth. Mm-hmm. That becomes almost a nightmare because now you got 12 installments and with possible growth. If not, then you're definitely doing something wrong. There's no growth. But now you got to convert all of that, less the growth over to including the growth over to the Roth. Some of that's going to be taxable, some of that's not. It's best. So what I would suggest, if you don't have, the ability to just do a lump sum, then convert it, I would suggest making those contributions maybe to a savings account, then, or maybe, high yield savings, once a year, push all of it to your Roths, to your non-deductible, and then convert the entire amount immediately. That way, and we're talking same day conversion, or at least no more than 24 hours. And that way we can, not worry about did it trigger any other gains,
right, or
additional taxes.
Right. So that's good advice. And the whole reason why we're talking about this is trying to create a bucket of tax-free money in the future.
Yes.
So, but why is that such an important planning tool in retirement?
Oh man, y'all! I pray I'm doing my best to make this as simple as possible. But if I have not, please understand the next thing I'm about to say. The reason why, listen to me. The reason why you want a bucket of non-taxable money in the future is because America is in financial trouble. I go through great lengths. I've been spreading this message for the last 10 years, last decade. The country is in financial trouble, and you may say, well, Reg, what does that have to do with my retirement? It has everything to do with your retirement, because the only way, and I don't care if the White House is occupied by a Republican, Democrat, or an independent, eventually, the only way we're going to get out of this, they're going to have to raise taxes a lot.
Yes.
A lot. I'm telling you, unpaid taxes in your retirement accounts is a huge liability because Uncle Sam can move that needle as they see fit based on what they need, right? So you're going to need a bucket of money that's exempt from that. And I'm telling you it's coming. You can look at our debt load. Matter of fact, go to usdebtclock.org. I think it's .org, usdebtclock.org. And you can see the trillions of dollars. You can see in real time the speed at which our debt is rising. And you will see that the debt is higher than, we owe more than we have, quite simply. You can look at that. Look at the fact Social Security is in trouble. Go to Social Security website. They tell you. It tells you the year they're going to run out of money in the reserve fund. It's not a secret. It's not a secret. Look at Medicare, running out of money. They tell you the year it's going to run out of money. The amount of debt plus Social Security is in trouble, Medicare, all this stuff, it all leads to one road, and that is a great, great strain on the American people in the form of increased taxes. So if all of your retirement dollars are in a spot that has to be taxed in the future, you really creating a definite hazard for your account. So that's why we're stressing it's very important that you have after-tax dollars available to you during your retirement years.
And I want to be sure you all understand something. When you have money in a pre-tax account that's going to get taxed in the future, it's going to be taxed at whatever rate the tax rate is then, not when you put the money in. And it's so easy to just put money in a pre-tax account, and it's kind of on autopilot. You don't think about it. But it doesn't matter what the tax rate is when you put the money in. It's going to be based on when the money comes back out. And if you look at our historical tax rates since the inception of the income tax, we are on the low end.
Right.
The average is around 50%, and we're at
37.
37, yes,
on the high end.
Down from a few years back, we were at 39.6, so it's 37 now. But we're on the low end. We're below average in our tax rates right now, and there's only one way it's going to go. I
can guarantee that. And like Eb said, it's low now, but it's definitely going up. And it's going up because, again, we need more money as a country, and you know, it's only so much, and they're certainly not slowing down spending. I don't want to turn this into no political talk. Y'all know I don't do politics unless it affects our finances. So that's why you hear me talk a little bit about it now. But I'm telling you, Eb is telling you, you're going to want money in an after-tax spot. So if when this tax tidal wave come, you'll have some money that's not included in that, okay? And there was one more thing I was going to bring up. Oh, yeah, I remember now. It was when Eb mentioned it's not going to be taxed at the tax rates. It was. Here's one thing. I remember years ago when I was getting started in this industry, we were trained to tell clients, hey, when you retire, you'll be in a lower tax bracket. Well, you know what? How and where did we know 20 years ago where taxes would be? That we were trained to say that based on the fact people would retire with less income, which the more I thought about it, that wasn't the goal. Nor did we have a window into seeing where tax rates would be. So, y'all, that fallacy of just automatically assuming you're going to be in a lower tax bracket, that is not true.
We deal with a lot of retirees, and most of them are not making less money than they did when they worked.
No. And again, taxes it's like moving a game post in the middle of a football game. So, guys, we got to take a break right here. When we come back, we're gonna flip it over to Eb's side a little bit, and we're gonna talk about self-employment tax and business owner blind spot. So stay with us through the break. We'll be right back. Remember, it's time to elevate. We are back, guys. You're with Reggie and Ebony on the Elevate podcast. This is episode 5 of season 3, and today we're talking about what your accountant isn't telling you about taxes and retirement. If you missed that first segment, we went over, something that's very important to high income earners and how they can participate in after-tax preparation for retirement. So go back and check that out if you missed it. But now we're going to flip the conversation over a little bit. We're going to come over to Ebony's side of the table. And Ebony, I want to talk about self-employment tax. I literally got a question about this from a client this week.
Did you?
Literally, this week. They wanted to know if what exactly was self-employment tax. And I'll let you explain it, because I probably explained it the right way to them. And something, we're getting some other stuff about business owners. So, Eb, tell us rather, what is self-employment tax really? And then I got a follow-up question to that.
Okay. So in plain English, self-employment tax is how you pay your portion of Social Security and Medicare when you are self-employed.
Okay. So if you're self-employed, you're not getting around paying that.
No, not at all.
It's just called something different.
It's just called something different. So when you get a W-2 and you look at your check stub, you'll see Social Security and you'll see Medicare. What you see that's been deducted from your check is half.
When you say half, what do you mean?
Half of what is actually owed. Your employer pays the other half.
So there's something owed to the IRS per taxpayer.
Correct.
Okay.
And this is to cover your Social Security and Medicare, ideally, in the future.
Okay.
When you're self-employed, there is no one to pay that other half of the tax on your behalf.
Gotcha.
So you're responsible for the whole thing, and it's added to your taxes at tax time. So in total, it's 15.3%.
15.3. Okay.
So what happens is when I'm working with my clients that are self-employed, that tax is charged only based on your profit. But in their head, they know general tax bracket. So I may be in the 12% tax bracket, or I may be in the 22% tax bracket. And then they look at the actual tax bill, and we're having to talk about why it's so much more than what they thought it was going to be, because they were only taking into account the income tax part.
Gotcha.
So if you're in the 22% tax bracket, your
Keep going.
money got taxed. Your income got taxed at 22%. Some of it, it's gradual. So
Right.
some at 0, 10, 12, 22. On top of that, you have to pay another 15.3%.
Now, I did not know that. So
Yes.
the self-employment tax, I'll make sure I get this. The self-employment tax is in addition to whatever tax bracket you fall into.
Correct.
Did not know that.
So when people say, dang, it seemed like I paid 30, 40% in taxes based on my income, because you kind of did.
Okay, so that's why it feels so much heavier
Yes.
than a W-2 tax.
Right. And the W-2, you don't see it in the same manner because it's coming out. One, you're only paying half of it. You're
Right.
paying 7.65.
Your employer's paying the other
The
half.
employer's paying 7.65, the other half. And it's coming out in smaller bites with your check. You don't actually see the money. But when you're self-employed, you're getting all of the money. So mentally, you feel like that money is yours.
Right.
You've earned this money, and now you have to turn around and give a portion of it back to the IRS.
Well,
So it just hits a little different.
Yeah, it does. Let me ask you this. So if a person paying quarterlies, you know how we pay quarterlies in, is any of that going to the self-employment tax, or is it going straight on the income
It
tax?
goes to whatever you owe. So both.
But you're paying quarterly sometime in advance, though, right?
Right. So when you pay quarterly taxes, you're just putting money on the books
I got you.
with the
I
IRS
got
to
you.
offset whatever your tax bill gonna
Whatever
be.
it come out to be at the
Right.
end.
If
I
you
got you.
if you gave them too much, you get a refund. If you gave them too little, then you pay the difference.
Got it.
Yeah.
I got it. Okay. So that's good to know, y'all. I'm not making this up. I literally learned that right now. Learned that today. So on top of whatever income tax bracket you fall, you also pay that self-employment tax. And so the question I got this week was, my client asked me, they're self-employed. They asked me, should they be putting money into Social Security, although they're self-employed? And I did know enough to say, no, if you're paying your self-employment tax, you are putting money into Social Security.
Now, I do want to bring this up because it happened to a client of mine, especially if you have always run your own business and you and your spouse work together. So if you are a sole proprietor or just have an LLC and it's a single member, you're filing it on your taxes. But when you do that, it's a Schedule C, which is how you record your business income and taxes and expenses, I mean. When you do your Schedule C, you click who that Schedule C belongs to. So what happened was, it was a husband and wife that had a cleaning company. They always filed the business under the husband. The wife got ill and needed disability.
Oh,
But nothing had ever been paid in on her behalf.
whoa. I see exactly where it's going.
Because you have, 40 quarters?
Yep, 40 quarters.
You have to have 40 quarters worth of income in order to be eligible for
to put into Social Security to be able to take out from it.
Exactly. And she did not have that.
Wow. Although she had been working.
She had been working because they have the business together. And
But
it doesn't matter
I
who
got you.
owns it on paper. It matters on what you file on your taxes.
That's interesting.
So when their accountant, this is before they started working with me, when their accountant clicked that Schedule C, that business income belonged to her husband, it was only attributed to him.
Wow. Man, and that really just kind of floored me. So in that instance, but can the Schedule C belong to both of them?
No, we
But
would
it
have.
flip-flop.
There's some other ways we can get it done. Yeah,
I got you. Okay. And also when it's crazy when, we solve problems through the lens that we've been trained. Because what I immediately thought was she should have had her own disability policy in place. and that would have taken care of that as well. But, you know, accounting ways where she could have done it too. So.
And at least been able to get something from the state.
Right.
Or the government. Yeah,
okay.
Right. So.
Very interesting, man. So what about when people write their income down every year to, you know, not pay taxes? But you go 3, 4, 5, 6 years of writing it down to nothing. I'm sure that's having an effect on what you're putting in the system too.
Yeah, it definitely has the effect because again, what you pay in self-employment tax is only based on the profit. So it doesn't matter if your business made $10 million in revenue, which means the money that you actually bring in is how much you kept.
Right.
So if you made $10 million, but you kept $50,000, you're going to pay taxes on $50,000 and self-employment taxes on $50,000. So that's the amount that you get credited for with the Social Security Administration. So when everybody gets statements that shows your income over your working years, it's going to be based on that bottom line number.
Right.
Which means that if Social Security is still around when you retire,
big if,
it's going to be based on that bottom line number.
Right.
You may have said, well, I made $500,000. You didn't pay taxes on $500,000.
See? And now, you know, banks are loan on whatever that part you're paying taxes
Sure
on
do.
now.
So you can't have it both ways.
You can't. And that, and I see that a lot, especially, you know, my friends in real estate investing, you know, of course you get, you know, getting a lot of revenue, don't want to pay all those taxes, so you write your income down with legitimate expenses. But when it's time to borrow money from the bank, they loan it off of what the amount you pay taxes on,
Exactly.
not what you brought in total. So it gives and it takes. I got another question for you, Eb. Why do you think so many entrepreneurs underestimate how much they owe in their taxes, especially in those first few years?
A couple reasons. One, sometimes it's difficult for people to make the transition. So if they had previously been in a position where they were an employee, a lot of times employees, if you have the right amount being withheld from your check and you don't have any type of side business or something going on, you shouldn't owe.
Right.
Because there's planning that can go into ahead of time so that you don't owe. So when you go from that to, I have to explain a lot, like you hadn't paid anything in. So off top, unless there's some credits available for various reasons, and there aren't many credits,
right,
you're going to owe simply because you're a business owner with profit.
That makes sense. I want to throw something there for you all. Y'all, she said there aren't many credits. There's a difference, and you don't have to go into this right now, maybe a different episode, between credits and deductions. And a lot of times, I know from just my limited knowledge on the tax side, people often confuse the two.
Correct.
Yeah, so we'll go ahead there.
So that's why people underestimate, and then they don't take into account, like you learned, that the self-employment tax is on top of the regular income tax. And the self-employment tax rate is flat. So whereas the income tax rate is based on what your profit was, self-employment tax is flat. It's 15.3%, period.
Of your net profit.
Of your net profit, period.
Got it. Very, very good stuff. So, well, now that makes me think about business structure. You know, whether a person's sole prop, they got an LLC, or like us, we got a C Corp. How does all of that, I know that factors into the tax filter, the tax window as well. Kind of walk us through that.
I will, and I want to start with a myth.
Okay.
So a myth that I hear is that all you have to do is have an LLC.
I hear that a lot,
and
too.
it'll help you out on your taxes. Listen to me very clearly. There is absolutely no tax difference between having a sole proprietor and an LLC. It makes zero difference on your taxes.
That's not what TikTok said, though.
All you gotta do is have LLC. You can go get a line of credit of $500 million from the bank.
Yeah.
Now, zero tax difference between a sole proprietorship and an LLC. If you have a business, whether it's an LLC or not, you have a right to deduct the expenses associated with conducting your business. Period. It's that simple. We're not going to get into this part, but because we're going to stick on taxes today. But the difference comes in between a sole prop and an LLC or another formal structure in liability.
Okay.
Should something bad happen, who got to pay for it? That's it. So again, that we can save that for a different episode. Right now, we are talking strictly about taxes. So what we can do, though, is there are some other business structures that will help you mitigate your taxes, like an S corp.
Okay.
So
now, isn't our real estate business an S corp?
Yes.
Okay.
How? Again, we're gonna go back to that self-employment tax at 15.3%. I don't want to get too in the weeds, but we need this for an example.
Okay.
When you have a sole prop or LLC, all of the income that you make is considered yours.
Okay.
You pay taxes on 100%, not at 100% the rate, but if your business made $50,000, you're paying taxes on $50,000. You're paying self-employment tax on $50,000. You can't segment it.
Got it.
When you have an S corporation, you actually can take some of the money as an employee and you pay self-employment tax on that, but you can take another portion of it just as an owner, and that's not subject to self-employment tax.
Gotcha.
So that's how you can save on taxes, by having a different structure. But an S corp is not for everybody. Like if you're just starting out and you don't know if you're going to be profitable, I probably wouldn't want to do that. You would want to make sure that you're making enough money to cover the additional expenses that it takes to have an S corporation, because there's compliance, there is an additional tax return, and some other
annual
filings, all of that stuff. So it doesn't make sense if you in the hole to do an S corp, because you weren't going to pay self-employment taxes anyway.
Right. Yeah, look, so what I take from that, Eb, is people know, I've heard, hey, like you just mentioned, I need an LLC. But and I tell people, there are multiple different business structures that you really have to kind of decision tree through which one is the best for you right now.
Yes. Because
I remember, guys, when we first started this business, we were sole proprietor. I remember we went to LLC, and now with C Corp. I'm talking about our financial planning company, and now it's a C Corp. But there was a progression there based on where we were, and based on what we understood, and now we made the changes that we needed to make.
And it's not one size fits all.
Right.
And y'all, please stop listening to TikTok.
Right.
TikTok
Unless
will
you heard
tell
this
you,
on TikTok by chance. I'm just playing.
TikTok will tell you an S corp is best in every situation, because you can save on taxes and you can pay yourself if you made $100,000, you can pay yourself $10, and the $90,000 won't be subject to self-employment tax. It's not that simple. The IRS, they're not dumb. They thought of that already.
I always tell people, I'm not a content creator that gives financial advice on social media. We're professional financial advisors that sometimes create content.
Exactly.
It's a complete difference.
And with the S corp, that example I gave where you paid yourself $10,000 and $90,000 was your dividends as an owner, the IRS sees that, and you have to pay yourself a reasonable salary, which means that you have to pay yourself what you would pay somebody else to do that same job.
To do that, yeah, that makes sense.
You're not tricking them.
No, not at all. I think we got time for one more question before we got to get out for this segment.
Okay.
And if you can work one or two of these in, what do you think some common tax write-offs or strategies that business owners miss because they just don't know? What's anything come to mind they miss because they just don't know?
Business miles a lot. So, and this is specifically business miles in your personal vehicle.
Business miles in your personal vehicle, okay.
So right now the business reimbursement rate is 72.5 cents.
Oh, wow.
So that's, and keep this in mind, you can take this same deduction whether you have a gas powered vehicle, an electric vehicle, or hybrid. Yes. Yep. So that's one. Another, being able to deduct your health insurance premiums if you're self-employed. And this could be, you can deduct 100% deduction for health, dental, and long-term care for you and your spouse and your dependents.
Okay.
But your business has to have a profit.
Okay.
So if you lost money, then you're not going to be able to take that deduction on top of that.
Gotcha.
And another one is hiring your kids in the business. So look, this is legitimate and legal, but we're not talking about your toddler sitting there looking cute. The kids actually have to be able to do work. It could be things like filing, data entry, etc. and you're able to legally shift income from you to them because they're not going to have to pay taxes on it if it's under the standard deduction.
All right. Well, look, Ed, I got to cut you off right there because we gotta take this pause right here. But guys, I hope y'all caught all that. If not, you'll be able to catch it on the replay on all your favorite podcast platforms. Stay with us through this last break. We're gonna come back. We're gonna be talking about some retirement, job transition things. We know we got a lot of people stepping out on faith, starting their business. We're gonna talk about some moves you don't want to miss as you do that. Remember, guys, stay with us, and it's time to elevate.
This is the Elevate Podcast, Season 3, Episode 5, and we're talking about what your accountant isn't telling you about taxes and retirement. If you missed the first 2 segments, you must go back and listen to them. We talked about everything from self-employment taxes to backdoor Roths, to tax planning and deductions. So we're going to keep the conversation going, but before I kick it back over to Reggie,
okay,
I do want to say that year-round tax planning is so crucial, and it's so much more helpful than once a year tax appointment. Because when you show up to my office in March with your shoebox full of receipts, most decisions have already been made. It's not a lot that we can do at that point to affect that year's taxes.
Right. You got to get in front of it.
You got to get in front of it. Tax preparation is looking backwards. Tax planning and strategy is looking forward, and that's what we focus on at P3.
I like that.
I just see you once a year in April or October, I can tell you what happened, but there's nothing we can do to affect what happened. We need to talk mid-year, and I do make that available.
And that's a big difference. And again, as some of our followers and listeners jump out there, start their own businesses, you're going to find you're going to be needing to forecast and plan out what you want to happen from a tax perspective versus in your W-2 life, you just kind of dealt with what did happen. Correct. So you got a lot more autonomy. And I tell you, a lot of the tax laws are written to benefit business owners, to be honest with you. That's just a fact. I mean, that's not my opinion. That's a fact. But again, you got to know how to navigate that world to take full advantage of it.
That's right. So I'm going to kick it back over to you, Reggie. What are some things that people don't know when they leave their jobs to build a business concerning their retirement and taxes?
Well, so, and I'm glad you brought this up because, we do have people that have reached out and say, hey, listening to you guys, I'm about to start my own business or what have you. And so this is going to be a big decision. So when you separate service from your employer, and we're talking about an employer where you had, some sort of a retirement plan there, could be a 401k, 403b, whatever the case may be. When you separate service from that employer, you actually have 4 options. You got 4 options available to you with this money that you've accumulated. And you have to look at all of them. All of them have, pros and cons. The first one is, I'm going to go through these kind of quickly. The first option is you can leave it there, and that's the one people choose the most.
It
is leaving it there. And because they're comfortable with it, they've become used to what the statements look like. It's just when people don't know what to do, they typically don't do anything. And in my opinion, it's not the best option, but it is an option. But most people leave it there. The reason why I don't like that option is you're still paying for fees to be in a plan that you're no longer using. You can't make any more contributions. True. The people that's managing the account, they're not managing it. They're babysitting the account. They legally cannot give you financial advice on that account. And what I mean, but you might say, well, I can call it. Yeah, you can call in and you can request money, but they can never answer this question. They can, if you ask them, what should I be investing this in?
They can't answer that.
They cannot legally answer that question because y'all don't have a financial advisory relationship. They can respond to your request, but they cannot respond to investment questions.
Correct.
So you're leaving a lot of money. I've seen people leave over $1 million just floating at an old employer, saying, well, that's what I'm used to. So
and it's on autopilot. But the economy is not on autopilot.
Absolutely not. Let the economy tank. Let the stock market tank. They're not going to move one bit of that money around for you.
Not without your request.
Not without your request. So you have to, because that's not the kind of relationship y'all are in right there. So that's an option. Cashing out is an option. Terrible option. Getting drilled with taxes. Don't like that option. The other option is you can roll it to another employer plan. And depending on what type of account you set, what type of business you start, you can attach a retirement plan to that, like Ed was saying, C Corp, LLC, or whatever the case may be. You can start your own company plan. You can do a direct rollover to your own company plan, or like a solo 401k or SEP or something like that, or you can roll it to an IRA. Those last two options I like the most.
Okay.
Both of which, because it puts you and your advisor in the driver's seat. You're going to have way more investment options. You can the fees you can watch more closely because inside 401ks you have no idea what they're charging. And just because you don't see it in your statement don't mean they're not charging. I promise you they are. But anyway, it's just way more investment options, way more autonomy, way more control as it relates to when and how much we pay the IRS.
So I do want to get into that more, but you mentioned before we go there, you mentioned cashing it out, and you kind of just mentioned it and glossed over. But I think people should know how serious it is when you cash money out, and it's just not. So you want to talk about it, or you want me to?
I'll talk about it.
Okay, go ahead.
So again, one of the options is going to be you left the employer. And they say, well, you got to make a decision to 401k. You say, you know what, just send me the money.
That's what people say. Send it to me.
Just send it to me. Guys, if you're not, so the first thing, it's a mandatory rule from the IRS. The employer must withhold 20% off the muscle to send to the IRS. Don't go up there cussing them folk out because they have to do it per the IRS rules. So 20% right off the bat, boom, gone to the IRS.
And I'm going to add, this is like, if you've done this is a no judgment zone. It's not about judging and be like, oh, you did something wrong. It's about us now, you're now learning what is the best thing to do because you don't know what you don't know.
You don't know what you don't know. And then if you're not 59, I'll deal with that part secondly. So the 20%, boom, gone off the muscle. If the amount you cashed out kicks you to a higher tax bracket, there could still be more due on top of the 20% when it's time to file your taxes. All right? That's when you go see somebody like Ebony and she say, oh, well, I see that you cashed out. They did take out the 20%, but they need another 12.
And so this is how the conversation normally goes.
Okay.
I'm explaining why their taxes, i.e. refund or lack thereof, looks different than the previous year. And I say it's because you had a retirement distribution of $60,000. And they say, well, no, they took the taxes out already.
Right.
No, they took some taxes out already. That doesn't mean that they took all the taxes that you were responsible for out already. So that, like he said, that 20% withholding, that goes towards it. That don't pay it off.
Exactly. And then, on top of all of that, if you're not 59 and a half, there's another 10% penalty, which is not part of the income tax. This is a penalty because you took it out before the specified time period. So all of that can be avoided when you cash out and you get the, you left with $250,000 when you saw it, but when you got the check, it was $148 or whatever the case may be. All of that can be avoided by simply doing one of those last two options, which is a direct rollover to an IRA or rolling it over to another plan that is a like account, a similar account.
So we talked about the consequences from a financial planning and initial tax standpoint. There are some additional consequences. So like Reggie said, when you take that money out and you say, just send it to me, that's income.
Right.
And it's taxed just like the other income from your job or from your business. It can push you into a higher tax bracket, which can cause your money and any other money you make to be taxed at a higher rate. What it can also do is kick you out of some credits and deductions that may have income limits.
Right.
So the American Opportunity Credit for college, the student loan interest deduction, and there are numerous others. They have income caps.
Right.
And if you get above that income, you cannot deduct it. It can also affect your healthcare.gov. So if you have insurance through healthcare.gov, I deal with this week actually. You put down how much you think your income is, and then they give you a subsidy to help pay your premium based on what your income is.
Okay.
Well, when you file your taxes, if your income is different and they gave you too much in subsidy, they're going to get it back.
They want it back.
And I had a client have to repay $7,000.
Ooh.
this week in subsidy. So we're saying all of this to say, get guidance.
Get some professional guidance. Yes. Right. Get some guidance, y'all.
Ahead of time.
And I want to jump back one more time. I want to be sure people don't miss this. So y'all, and I can't, without meeting you, I'm not telling you what I think, I can always say what I like the best. Leaving it where it is. Too many of you all have left jobs, but you left your money there. That makes no sense to me. And I'm not judging you. Let me be clear. I'm not judging you. What I'm saying is you need to be in more of you need to be in a driver's seat when it comes to that. Leaving that money where it is just because it's what you're used to, or that's, well, my money's doing fine there. You don't know that fine is relative, right?
Correct.
Because, you may get 6% there, but the market may have done 19%. But you just know that's where it was, and you're just doing it because that's what you're used to. I strongly encourage you to seek some financial advice and see if, in fact, after meeting with the advisor of your choice that know what they're talking about, if you still want to leave it there. But just as a default setting, I strongly encourage you not to do that.
We can't take a passive stance toward our money in this economy. You have to be proactive to make sure that your money is going to last.
You do. And one more thing, I want to throw this in here too while we're talking about this retirement money. I've talked about this, I think it was way back in season 1. I'm not a fan. I'm not a fan of using these particular dollars to start whatever business it is that you're starting. I'm not saying it's an absolute, don't do it. I'm not a fan of it because I believe there's other ways to access money to put at risk in your business than to access and use your hard-earned retirement dollars to do that. So just know, cashing out a 401k to start your business, I would not make that a first or second financing choice for a business that I was starting.
Okay. So speaking of businesses and retirement, how do those retirement strategies differ if you're an employee versus a business owner?
What particular strategies?
Just your retirement strategy overall. Like what additional considerations do I need to make if I own a business?
Well, one of the biggest ones is when you're an employee, and let's say you're working somewhere where there is a match. And I do want to say this, guys, if where you're working offers a match, take advantage of it. If you got to put in 4% to get the full match, 5%, take advantage of the match. That's free money that you leave it on the table if you're not taking advantage, if you're opting out. So that's one thing to consider right there, because let's say you're contributing $5,000 and your employee contributing, another $2,500 a year. That's $7,500 going into the retirement plan for you. Once you step out there and do it yourself, it's all on you. So oftentimes what happens is in the world of business, all that revenue we need so much to, pay ourselves current income, to take care of current debt obligations, whatever it is you're taking care of, that you actually kind of put retirement on the back burner. And that could prove to be a mistake. Always remember this, guys. Remember this. It takes 3 things to grow money. It takes principal, that's the money you put in. It takes interest, that's your rate of return. And it takes time. Of those 3 times, the only one we have no control over. So if you say, well, you know what, I'm going to start contributing to my retirement next year. That's an entire 365 days of compounded interest that we can't get back. I don't care what the rate of return is in the following year. We can't get that back, all right? So that's one of the biggest considerations people make is I'll start contributing to my retirement once the business matures, once it gets profitable, once it da-da-da-da. No, you need to factor that in on the front end because you cannot get that time back.
You cannot get it back. And I would say, I hadn't done the statistic, but I would say probably 8 out of 10 business owners who actually bootstrap their business, they're not setting aside retirement day one because you are trying to survive and make your business profitable and sustain your business. So retirement is in the far back of your mind.
Not only are most businesses not factoring that in, like you said, they're bootstrapping it. Then on the back end, I've seen so many people walk away from business, not even considering the fact that you can sell it as an exit strategy. Guys, listen to me. If you're a business owner and maybe you didn't put aside funds for your retirement because you worked and toiled all those years just to keep this thing going, do not just walk away from this business. Let's see if it can be sold.
Right.
That could be your exit strategy. You've built, it's worth something. All right. There's somebody right now that's talking about walking away from a business. I've tried to talk them out of it. I don't think they're listening to me, though, because they say, well, ain't nobody going to want to buy it. You don't know that. You hadn't even tried.
You got to tell me who it is. I have a contact for them.
It's going to surprise you, too, but go ahead.
Yeah. Oh, my gosh. Listen, y'all. If you took the time and the sweat equity and the tears and the bounce checks and the loans and everything to get your business going because you said, I'm going to make it happen no matter what, get the reward at the end.
Yeah.
Because your trajectory for your retirement is going to look different. Because if you didn't start a regular W-2 job coming out of college, you didn't have somebody contributing to your retirement from day one. So you have to think about things in a non-traditional way. And part of that, your retirement package can be selling your business. So don't get this far and then forego the reward. Absolutely. And every business, if there's a business out there, is somebody willing to buy it.
Doggone right.
Period.
That's right. So, you know what? Time has flown by. We have to wrap this episode up. So, y'all, this has been, as always, we hope this information has hit home for somebody. And if it wasn't right for you where you need right now, you know someone else that could use this info. Find us on YouTube or any one of those social media podcasts and tag that individual, man. It's just good. What you all just listened to, for those that listen to all of it, we charge people a lot of money for this. Yeah. All right? This ain't... we putting it out here on the airways right now, but I'm telling you, this is free to you right now, but it ain't always free. I'll just say it like that, all right? So anyway, as we're wrapping up, some things you want to think about. If you left your job tomorrow, would you know exactly what to do with your 401k? As a business owner, do you have a strategy or is it just a hustle? Have you grown to a place where you need tax planning in addition to the tax preparation? And, are you earning more money, but you still feel financially behind? So these are things I want you to think about. Ed, tell them where they can locate us and connect with us.
You can give us a call at 901-209-4015. On social media platforms, you can reach me at Eb the Advisor. You can reach Reggie at The Money Jedi.
That's right, guys. Stay. You know what? Next week, we should have, if scheduling goes well, we have an exciting guest that'll be in the studio with us. And she's going to be talking about her business, her walk through entrepreneurship, and all those sort of things. So I'm really excited about that. But anyway, stay with us, guys. Keep it locked right here, right now. You're on Power 104.1 FM. We'll talk to you soon. Remember, it's time to elevate.